What is going on, traders? So this is the best year-to-date rally that we've had since 1997. That is right, the dot-com boom. I know that sends shivers down some people's spines because of the comparisons between what happened or how the dot-com boom ended and what people are feeling now in the markets. That is why I think this is an important video, because while most of us who have been invested in blue chip stocks and quality stocks are certainly seeing an exuberant rally this year, you still want to be wary and look at historical data in order to try and determine how to protect your portfolios in the near term. So we'll take a look at historically what happens to the S&P 500 and the stock market in general after seeing such a year-to-date rally. How does the year end and what is to come? And as always, I'll also be giving you an update on the current plays and let you guys know what I'm looking at for the upcoming months. If you get anything out of this video, leave it a big fat thumbs up just like this. Leave it in the comment section below. Let me know what you think of the current market conditions. You definitely want to stick around because this is some extremely important info and data. Let's get right into it. So, as I said, the S&P 500 hasn't seen this type of year-to-date rally since 1997. Now, obviously, history has no guarantees, especially in the markets. But if we take a look at this chart here, put together by LPL Financial, thank you so much for this research, you can see that going back to 1954, when the stock market has had at least a 15% year-to-date gain, the final 4 months of the year end up positive. Let me zoom into this chart a little bit. So taking a look, going all the way back to 1954, you could see here that we've had what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. We've had 15 years where the year-to-date gain up until August is 15% or more. And in all but 2 of those, we ended the year higher. And in the last 5 years, the last 5 times, we've seen positive returns when the stock market has made year-to-date gains through August of 15% or more. Now, one important quote by Ryan Dietrich, who is the chief strategist at LPL, he says, one of the common bear worries is stocks moving up a lot means stocks will come down a lot. That simply isn't true, fortunately. And if you zoom out and take a look at the macro movements of the markets, especially over a long period of time like this, going all the way back to 1954, you'll see that is actually true. That just because the stock market is exuberantly high does not mean that we will see a crash. However, I do think personally that there are conditions for a correction, and this largely has to do with Fed policy. And you can see here that he says corrections are a normal part of investing, and the S&P 500 has yet to pull back even 5% so far this year, something that happens on average 3 times per year. So it has not happened yet, and it is August. And if you're a fan of this channel, you know that we always say the S&P 500 and the Dow Jones this year are the only 2 indices out of the 3 main ones that have not seen a correction. The NASDAQ has seen a 10% correction. It even saw a double dip correction. However, the fear of a pullback or a correction, in my view, is not a reason to stay divested out of the markets, meaning it's not a reason to not invest in the markets, in my view. Obviously, it's your money. You could do what you like, consult with a financial advisor, blah, 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 blah. But in my view, it is not a reason to not invest in the market. I know people that pulled out their money in 2015. I know people that pulled out their money at the end of 2020 thinking that it was already too high and that because of COVID, we would see a double dip recession. No, in my view, you should dollar cost average into the indices and also find individual stocks that you think are undervalued based on the current market conditions and the conditions of the fundamentals of that company. And we'll go over some potential plays towards the end of the video, but more on the current market landscape. So will the stock market end the year positive? Overall, I think the stock market will end the year positive, but will the last 4 months be positive? Here's why I think there's actually a bearish case. It all has to do with the Fed. So as we know, the Fed has been deploying a ton of strategies. They've been pulling out every single clip that they have in their vests in order to try to upkeep the economy. Now, I'm not going to go through this entire article, but there is a former Fed official who's called Don Kahn. That is actually a pretty dope name. Don Kahn? Don Cohen, maybe? Don Kahn is better. He says the current situation is replete with unusually large risks of the unexpected, which if they come to pass, could result in the financial system amplifying shocks putting the economy at risk. Now, in summary, the reason he believes this is because of this dangerous duality here, right? He thinks that asset values have risen to historical highs, meaning stock prices. But in addition to that, private debt has reached near record levels. And because the Federal Reserve is already engaged in aggressive monetary stimulus, he thinks that there are limited tools or no more tools to deploy if shit turns bad, basically. You couple that with the fact that the economy is still reeling from a pandemic, and the consumer index numbers just came out today as of the time of this recording, and it dropped to a 6-month low because of the anxiety surrounding Delta, the delayed full reopenings, etc. So in my view, if you take a look at the S&P 500, again hitting an all-time high this week, it seems like 2021 is the year of record highs. I don't think there's ever been a year with this many record highs. I do think that the market conditions right now are ripe for a pullback at some point within the next 4 months, meaning by the end of the year. The fact that we haven't had a pullback yet on the S&P 500, the rising anxieties surrounding the Delta variant, the fact that there aren't really any more catalysts besides one, which is the infrastructure bill, but that is largely priced in my view, we could easily see a slowdown until the next holiday season. This is why we continue to open hedges against our positions. Currently, we have a hedge against the VIX, which is the volatility index. I've described this in videos before. You can obviously sell covered calls against your shares. You could buy protective puts. You can play the VIX. You could play inverse ETFs. There are many ways to hedge. I've talked about this ad nauseum in previous videos. You can see the VIX here hitting support. It is increasing today. It's up almost 4%. So we are up on that position. And I will keep this open in case we do see a spike in the VIX. Generally, it moves inverse to the stock market. When the stock market tanks, we do see the VIX go up. Remember, the VIX is just a volatility index. You can think of it as a fear gauge. And in terms of new trades, we've really been utilizing neutral strategies, especially around binary events like earnings. We have a pretty high probability trade on CrowdStrike that allows us to be anywhere between $242 and $324. This is called a double calendar spread. We opened up an Iron Condor on FUTU, closed that for 70% this morning. We had a call spread on PayPal, a call spread on Amazon. Now, the reason that we opened those bullish trades on those two is, as I was saying, in these market conditions, you want to look for value on quality stocks. Amazon just last week was sitting at the 300-day moving average, almost up 10%. As I said before, if you're not willing to take a 15% discount on Amazon, then really what are you investing for, or what are you investing in? PayPal absolutely killing it since bouncing off the 200-day moving average. I'm intently looking at the bank stocks here after forming this double top. We did re-enter XLF when it hit the 200-day moving average, but now it is forming this double top here. And we do see that fintech firms like Affirm are actually rising while bank stocks are declining because those fintech firms are actually disrupting the banking industry. So I do think that there might be a position, another re-entry on XLF, which is the financial sector of the S&P 500 soon. So I'm keeping this one on my radar, as well as MasterCard and Visa. I know MasterCard is now sitting at the 300-day moving average. This looks like a falling knife at the moment, so I'm waiting to get into MasterCard, waiting for it to find support. Visa, same thing, sitting, I believe, at the 200-day moving average. Oh, not even quite there yet. We might get Visa at around the 220 range. So again, I'll wait for it to find support here. I mentioned ExxonMobil. XOM is the ticker symbol, sitting at the 200-day moving average here. And we do see a spike in oil, especially since the hurricane has been wreaking havoc in the south. Hopefully everybody's safe. We'll look for an entry on XLE soon, which is, again, the S&P 500 sector that tracks energy. If Palantir breaks out of this inverse head and shoulders, I can easily see it trading in a new landscape in the $30 range. Also looking at NEO here, sitting at the 300-day moving average. So yes, there are a ton of quality stocks that appear to be undervalued at the current moment. Zoom, I'm looking at as well. I started dollar cost averaging into Zoom. It did tank, even though it beat on EPS, on earnings, and it beat on revenue. Zoom actually did tank because of soft guidance, even though it reported its first billion-dollar quarter. So I'm looking at further dollar cost averaging on Zoom, waiting for it to see if it can find support here or if it will break through support and cross below to that 240, 250 range. But yeah, those are just some of the plays that I'm looking at. Just giving you an example of how I'm looking to invest. Obviously, obviously, dollar cost averaging in the indices, whether it's the Qs, QQQ tracks the NASDAQ, the SPY tracks the S&P 500, dollar cost averaging in these has never done anybody wrong over the long term. But also looking at individual stocks that I think are undervalued currently. Doesn't mean that you have to buy Apple at an all-time high or buy Microsoft at an all-time high, again, unless you are dollar cost averaging in those. Anyway, traders, that is it for this video. If you want access to all of our trades, link is in the description below, so sign up. Let me know in the comment section what you think of the current market landscape and what stocks you are looking at to invest in. If you want to learn how to trade options, there is a beautiful link in the description to a course that I spent 100 hours putting together. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.